Let's take a look at the first learning objective and the second one, just in a nutshell, the bare minimum. I would like to talk about generally accepted accounting principles and how they're related to a couple of other definitions that you will see in this learning objective. Let's take a look and go actually to the beginning of last century in the United States when we, as you remember from history, we had Great Depression in the United States. How did it all come about? The stock exchanges were actually booming, and a lot of companies were issuing shares of their capital, and they were trying to sell them to the outsiders. Now, the drawback was that nobody was actually checking officially their books. So I can print and show you my financial data, and I can claim whatever I want to. And quite a few companies provided falsified data, and as a result, there was a large crash in the market that spiraled the country into the Great Depression. So there was a large outcry from the public to the government saying, do something about it. So as a result, there were several securities acts reenacted in 1933 and 1934. And one of them established what you know now as Securities and Exchange Commission. So this is part of U.S. government, also known the acronym SEC. So if it is part of the government, they do have agents that could wear a gun, and they can put people to prison. For example, Martha Stewart for insider trading. But the Securities and Exchange Commission did not want to set the standards for accounting. So they decided to delegate that work to the board of accountants. So that's how we have now financial accounting. So you know that there's financial and there's also managerial accounting. So this is only financial accounting. Standards, think of them as rules of the game. Board. So we have quite a few representatives from either public accounting, private accounting. So public accounting will be auditing firms that you might know. Private accounting could be, for example, Deere and Company, Caterpillar, etc., and academia. And they set the standards or rules of the game where those companies that sell shares to outsiders, or also known as publicly traded companies, are required to follow or adhere to. So those principles are called generally accepted accounting principles. And I cannot say that they are universally practiced. These are for US only. And again, it's only for publicly traded companies. Think large ones that trade shares on stock exchanges. So if you have a smaller mom and pop company, privately held, they do not have to follow these rules. We also have a different standard setting body for the international countries, and it is located in London. So that's an international accounting standards board. So some of you, the international students, you might want to look up for the fun of it if your country belongs and follows to the international accounting standard board that produces IFRS. So those are international standards. I'm going to go and continue on to 4 measurement principles that you will come across. The first one is historical cost principle, or simply we could refer to it as cost principle. So we will record all the assets, and I know you don't know the word assets yet, it will be coming later, but let's think of it as anything in your books that you purchased will be recorded at cost or the price that you paid. Don't confuse it with fair value. What's fair value? That is the price that you think you will receive or sell an asset or settle a liability right now currently. So obviously we could have a very large time lag between these two. It's a little bit of a trade-off. What do I mean by that? Because, for example, if I bought a piece of land 100 years ago for $5, it still will have to be listed in my records for $5. Well, that's not even relevant, right? Because it was $5 100 years ago, and now it could be dramatically much more. However, it is the price that I truly paid, so it's faithful representation. I know I paid it. Because what happens if I try to follow fair value principle? I think this parcel now is worth $100,000. My neighbor thinks it's 105. I got an appraiser, he said 110. I got another appraiser, he said it's 98. So all of a sudden I have 5 different values. And I would not truly know what the value of that parcel is until I try to sell it right now. Then I will have the new fair value principle. So about 99% of all of our assets, of everything that we record, has to be recorded at cost. Very, very few, as you learn in the later chapters, will be recorded at fair value. Why is that? Because I can easily and readily look up the value of those assets right now. Hint for you, that's your stocks. So you can pull up on your phone and tell me how much the stock of Deere & Company is right now. And you know it's a truly fair value that you can trust. We have a couple of more. One of them is monetary unit assumption. That's pretty easy. We record all of our data in terms of money, so US dollars. So I cannot put bushels of corn or lumber and yards or whatnot. It has to be expressed in dollars. And the last one, economic entity assumption. So I have to record activities of entities, couple of different entities separately. So for example, I cannot combine Kellogg and Caterpillar, or I cannot combine transactions of the owner and transactions that belong to the company, even if it's owned by the owner the same. So as well, basically personal pocket is personal versus corporation or a business must stay separate as well.